There are two types of trades in the Forex market. There is buying, where you are investing into the growth of a currency, and then there's selling, where you're investing in the price decline of a currency. And most people totally get that when you buy, you want to buy at a lower price and then sell at a higher price. And in doing that, you make profit minus any cost incurred in the difference. And that's where your profit is. But where people have a lot harder time wrapping their minds around is, how do you make money selling in the Forex market? Because it looks like you're buying at a really high price and then selling at a lower price and somehow still making money. And I totally had the same exact question when I began studying to trade Forex, and getting my head wrapped around that was a step that I needed in order to move forward with a strong foundation and an understanding of Forex trading. So let's get you squared away with that knowledge right now. Buying or placing buy trades in Forex really mimics our traditional retail marketplace transactions. Buy low, sell high. And in this example, we are looking at the US dollar Swiss franc pair, the USD CHF. That's what we're on. And we're entering here at the bottom, right here. And this was in an uptrend, and we got our entry signal, and as we are entering here at the bottom of the uptrend, the price is 0.9382, and we enter a buy order entry right here. And in our example, we are going to purchase 10,000 units, which cost us, since it's trading at this 93.82, it's going to cost us, in our example, $9,382. Now remember, you can do this with the help of leverage, and because of that, you do not have to put up the entire $9,000 to control this size trade, which is really cool. Now, in this example, price absolutely, which is awesome, goes in our favor, and we see the currency price increase here into a price point of 0.9854. And let's just say that we see the market starting to kind of go into some consolidation here and failing to push price higher. And according to our trading plan, we decide to exit the trade and close here at this 0.9854. At the point of closing this trade, we are actually selling our units at the price of this 0.9854. And when we sell our 10,000 units, we receive $9,854 because we bought low here and we're selling high here. And so this is what we're getting. And this just gives us a profit of $472 in this example. And we can totally understand this concept because in our minds, we actually purchased something at a price that was low, and price then and value increased, demand for it increased. We took what we owned and we sold it at our higher price, and we made profit. That is solid construct. It's easily understood. But what happens when you try to sell something that you don't own or already have? That's where short selling comes in. So let's take a closer look. First off, the proper term is actually short selling because you don't actually own what you're selling. But when people talk about it and when you hear it referred to, it's usually just shortened to just selling or shorting a pair. And the flow goes like this. You look at your trade analysis, and in this example, it's the US dollar franc. You look, and your trade analysis, your technical analysis tells you that you get an entry signal that the dollar franc is going to drop, and so you want to short this pair. You contact your broker and you borrow enough for your trade size, and in this case, it's 10,000 units or dollars, because we are trading the dollar franc. And remember what we're doing, we're always doing to the base currency, which is the very first currency that's listed. So in this case, it's actually on American dollars. The price of the dollar franc is currently trading at 0.9245. So you take these borrowed units and you sell or short them at the price that this pair is currently trading at this 0.9245, and it costs you, remember this amount right here, it's going to cost you $9,245, and that's essentially what you have now borrowed from your broker. Then you are going to hold on to your 10,000 units, and then the trade is going to, we hope, go in your favor. And in this example, it does move in our favor, which means that the price on the dollar franc drops. And you keep holding until, according to your strategy or your trading plan, you have an indication that it is time to exit and close your trade. So you're going to close out your trade, and the new price, because the trade went in your favor and you shorted this pair, the new price is 0.8857. You then are going to use your borrowed, remember, 9,245, that's what it costs you here, to buy back. You're buying back units at the current price of 0.8857. In exchange, you are now going to receive a total of 10,388 units because the price is lower instead of your original 10,000 units. And you're going to pay the same amount, which is your $9,245 here. So you close your trade at this new price. Then you're using your borrowed money to buy back as many units as you can at the same price. And you are getting an excess of 388 units from your original 10,000. Now, you got to return those 10,000 units back to the broker. So that goes back into their hands. But what you have, again, is your 388 units, which in this example equals a profit of $388 because your account is in US dollars. And you rinse and repeat this with a proven profitable strategy that is accompanied with awesomely disciplined trade management in order to maintain a consistently profitable trading experience. Remember that you are doing everything to the base pair of your trading currency. So if you were trading a pair like the euro dollar, your profit right here would be in euros. And so you would at that point have the euros profit converted into US dollars because your account is in American dollars. And all of this is handled seamlessly by the broker. You have made your money through the buying and selling of currency with profit, hopefully, on the foreign exchange market. And the broker has made his money through the spreads that you're being charged. Remember, we talked about the bid and ask prices as well as commissions or fees depending on the broker. Let's look at this same thing on a chart screenshot here. Here on this sell example, we are still on the dollar franc up here. You can see that. We see that our analysis gave us an entry signal right up here on this candle that closed at the 92.45. Okay, that's where we're at. And we wanted to place a trade for, again, with our example, 10,000 units. And at this price, so we went and borrowed that from our broker. We then took that money and we placed a short sell of 10,000 units at the current price that pair is trading at, in this example, 92.45, and it costs us $9,245. And that price is going to vary depending on your account size, your lot size you're trading, and all of that. It's not always equal $1 as it is in this example. And you hold on to your pips while the trade goes in your favor. In this case, price is falling, and as it falls, it comes all the way down here to this price of 0.88 0.8857. And at that time, you get an exit signal from your trading plan or strategy so that you decide then to close out your trade. At the time that you close out your trade, you are going to be buying back the units with your borrowed total amount of this 92.45 at the new price of 0.8857. It is again still going to cost you 92.45. Okay. And in this example, we're getting back 10,388 units at the lower price than our original 10,000 units. So you now give 10,000 units back to your broker and you get to keep this additional 388 units that's to be converted back into your bank account currency. This money is kept in your broker account until such time as you withdraw it from your broker into your personal bank account. And remember that you cannot count profits until you withdraw from your broker. There is a balance when you're learning to trade to be struck between leaving money in your brokerage account to be able to trade larger size lots and to compound your money, and then withdrawing your money so that you can pay yourself and claim your profits. And that's something that you'll kind of have to work through as a trader. Now, you'll find various different details on short selling when trading the stock market versus Forex, because you're dealing with stocks and various different ownership rights to the stocks and not trading currency. Trading currencies is dealing with trading actual money and currency, so it can be a little different. But as you see here, while the flow of selling is a bit different from placing buy trades, once you understand what's happening in the background, you can navigate the taking of profits, whether you're buying or selling your base currency in Forex trading. And listen, the execution of trades works exactly the same on your broker platform, whether you're buying or selling. So in your mind, you can just kind of know what's happening in the background. But from an execution standpoint, you're basically just going, okay, what is my bias according to my technical or fundamental analysis? I'm either buying or I'm selling. And then you are executing a buy trade or a sell trade, with good profit loss management, good risk to reward, good trade management. You're going into that, and that is going to be done according to whatever platform you're trading on. But all of this knowledge of short selling is kind of in the background, just of your mind, of how is the money actually made. And again, it's pretty cool the way it's set up, because from your standpoint, your execution and your actions are the same, whether you're buying or selling.